Okay, students, so for today's video, we will be learning about short-term financing sources and cost. So this is another topic in continuation with your subject, business finance. So for this topic, we will be talking about the sources of short-term financing. These are accrual of expenses, suppliers' trade credit, bank loans, commercial papers, pledging, and factoring of receivables. So we will be focusing on number 3, which is the bank loans for this topic. We are not hindi natin i-discuss yung accruals of expenses, yung suppliers trade, commercial papers, pledging, and factoring of receivables, because according to the MELCs given by the DepEd, we are to focus only on the topic bank loans. So, cost of bank loans. Cost involved in acquiring short-term funds from bank loans includes the cost of bank borrowing or the cost of bank loan. So, the cost of bank loan borrowing depends on how the bank imposes interest on the loan. Banks compute interest using the following method. We have the simple interest rate, discounted interest, add-on interest rate with compensating compensating balance. So for this, sa mga enumerate dito na sources of short-term financing, we're only focusing on bank loans, and then for the cost of bank loans, we are focusing only on the topic simple interest rate and then discounted interest rate. Why are we talking about bank loans? Because di ba kapag magnenegosyo ka, kailangan mo ng pera for capital. So it can be from your own pocket or from the loans that you wanted to acquire from banks. And it is also stated here that bank loans imposes interest on loans, and it depends on the bank of how much is the interest on the loans, because different banks are imposing different interest rates. Okay, cost of bank borrowings using simple interest. So the term simple interest rate indicates that the borrower receives the face value of the loan and pays the interest only at the maturity date. So if you are acquiring a loan in the amount of 100,000, immediately the 100,000 if inapprove na ng bank yung loan mo with the amount of 100,000, the face value, which is the 100,000, is agad-agad mong makukuha. Thus, upon the maturity, the payment will include the principal amount borrowed plus the interest. So when you pay, it is the principal amount plus the interest. The maturity period of the loan with simple interest may be 1 year, more than 1 year, or less than 1 year. It depends on you. If example, you applied for a 100,000 bank loan and you wanted to pay it within 1 year. So it depends on you, the borrower, on what are the terms of your loan that you wanted to acquire from a bank. When the term is a year or more, the annual nominal rate of the bank loan and the annual effective rate are equal. However, when the term of the loan is less than 1 year, for example, 120 days, the annual nominal rate is lower than the annual effective interest rate. So there are different in terms of the term of the loan. Pag 1 year siya, ang nominal rate niya at ang effective rate niya is equal. But in terms of less than 1 year, so hindi sila magkapareho ang nominal rate at ang effective interest rate. That is why we need to compute those interest. The term effective interest rate refers to the real or true rate of interest. So yun yung ang totoong interest ng bank loan na kinuha mo from a bank. If the term of the bank loan is 1 year or more, the nominal interest rate is equal to the effective annual rate under simple interest. However, if the term is specified on the bank loan is less than 1 year, says 90 days or 120 days, the effective annual rate is annualized for comparison to be easily made. In this case, the effective annual interest rate is higher than the nominal annual rate. So, it was stated a while ago na magkaiba talaga if the term is less than 1 year. Magkaiba si annual interest and the effective annual interest. I mean the nominal annual rate and the effective annual interest. So, this is the formula to compute the effective annual rate in the term of the loan in terms of 1 year or more. So, EAR is equal to I over P times T. So, where EAR, so dito sa formula, ito, ang meaning niya is effective annual rate of interest. And then for the equal, which is the I, is the amount of interest. And then P is for the principal and T is for the time. So that is the formula on getting the effective annual rate for 1 year or more term in your bank loan. If the term of the loan or the period term is less than 1 year, the formula to compute the effective annual interest using simple interest is as follows. So as you can see, magkaiba ang formula ng more than 1 year or 1 year in term. And then, magkaiba din ang formula ng less than 1 year. Wherein, EAR, it means effective annual interest, effective annual rate of interest. And then, PIR means periodic interest rate, which is computed by dividing the annual rate by the periodic term. And then, PT is periodic term. So this formula is EAR is equal to open and close parenthesis 1 plus PIR exponent PT minus 1. So ang exponent lang dito is the PT, which is the periodic term. So now let us proceed to the illustration for you to be able to understand on how you will compute the effective annual interest rate. So in illustration number 1, Hazel Merchandising borrowed 300,000 from Partners Bank at 15% simple interest for 1 year. So the interest has been stated, it is 15%. The principal has been stated 300,000, and then the time has been stated for 1 year. Now, the requirement for this problem is compute the effective interest of the bank loan. So now, we will proceed to the solving. Okay. First, you will have to identify the given on the problem. Okay. So the first given is the principal, which is the 300,000. And then you will have the rate, which is the 15%. And then for the time, which is 1 year. So for you to be able to get the effective interest rate of this problem, diba? Effective annual interest rate is equal to, because it is 1 year, so yung 1 year na formula yung gagamitin natin. Interest over principal times the time. So the interest, kukunin muna natin yung value niya. So for the interest, which is the simple interest, very familiar ito na formula sa inyo, which is the interest is equal to principal times the rate times the time. Okay? So, ito, hindi to siya percentage. Dapat amount ito. In amount siya, hindi in percentage. So, you will need to get first the interest amount. Okay? So now, we will compute for it. The principal is 300,000 times, sorry, hindi nagpo-focus masyado yung camera, times the rate, which is 15%, and times the time, which is 1 year. Okay? Kuha niyo po. Okay, so that is the solving. So when you solve for that, you will get the amount of 45,000. So solve mo lang yan. Lagay mo lang sa calculator mo ang 300,000 times 15%. Kung anong makukuha mo dyan, i-times mo sa time mo, which is 1 year. So ganyan yung pagkukuha ng interest. So this will be your interest. Now, you will proceed to your formula for effective annual interest rate because we are getting the rate, okay, the percentage. So the effective annual interest rate is interest over principal times time. So 45,000, which is from here, divided by 300,000 times the time, which is 1 year. Okay. So directly, first na i-operate mo is the 300 times 1. So 45,000 over 300. Ba? Because times 1 lang siya eh. So walang magkakaiba. And then, you will now get the answer, which is 0.15. So this will be your ER. Your ear. So that is the effective interest rate or the effective annual interest rate of this problem. Illustration number 1. So the effective annual interest rate is equal to as you can see, the effective annual interest rate is equal to the rate given by the problem, because it was stated a while ago in our discussion that when the loan is 1 year in term, the nominal interest rate and the effective annual interest rate are equal. So those are the computation for illustration number 1. Now, we will proceed to illustration number 2. Easy Merchandising borrowed 500,000 from Partners Bank at 15% simple interest rate. Simple interest for 90 days. The required compute the effective interest of the bank. So for illustration number 1, it is for 1 year. Now for illustration number 2, it is less than 1 year, which is 90 days. So for this problem, we will be using different formula. So we will first identify the given of the problem. The principal is 500,000. And then the rate is the same, 15% with the illustration number 1. And then the time is 90 days. So when the term of the bank loan is less than 1 year, you need to divide it with 360 days. If the term of the problem is 120, 100 days, you need to divide it with 360 days. So for this problem, the formula to get your effective annual interest rate is 1 plus your PIR exponent to PT minus 1. So now for this problem, for the problem number 1, you need first to compute for the interest amount. Now for this problem, you are to compute for the PIR, and the PT. So first, you need to compute for the PT, which is the periodic term. For the periodic term, it is the rate, it is the term man siya, no? So ano yung term ng problem it's 90 days. So, kabaliktaran lang siya neto, di ba? 90 divided by 360. For the periodic term, what will happen is 360 divided by 90, then you will get 4, right? And then, for the PIR is equal to the rate divided by your PT. So, the rate for this problem is 15% divided by your PT, which is 4. Then you will get the 3.75%. So, you've already get the PIR and the PT. Now, you will proceed on distributing these amounts or these numbers to the formula. So, 1 plus the PIR, which is 3.75 to the exponent of 4 negative 1. Okay, so it will be 4.75 exponent of 4 negative 1. And then you will get the 15.87%. As you can see, in the problem number 1, the nominal annual rate is equal to the effective annual rate, right? Now, on the problem number 2, from the nominal rate, the effective annual rate is higher. So, it was discussed a while ago, right? In the discussion of ours, that when the term of the loan is less than 1 year, then the effective annual rate will be higher than the nominal annual rate. So that is for your illustration number 2. Now we will proceed for illustration number 3. This is the last illustration for the simple interest. Nicanor Merchandising borrowed 800,000 from Partner Rural Bank at 14% simple interest on 1 year and 6 months. Compute the effective interest of the bank. So, identify first the principal, which is 800,000, and then the rate, which is 14%. The time is 1 year and 6 months. Okay, 1 year and 6 months. So, the formula for getting the effective annual interest rate is the same with number 1 because magkapareha ang formula ng 1 year and more than. So, the 1 year less is less than 1 year lang yung magkaiba. So, interest over principal times time. So, there is interest. So, you will get first the interest amount, which is the principal times rate times time. So, the principal is 800 times the rate of 14% times the time, which is 1.5, because as you can see, 1 year and 6 months. So 1.5 because 6 months is half of the 1 year. So you will use the 1.5. So now you will get the amount of 168. 168,000 is the interest for this problem, the interest amount. So 168,000 divided by the 800,000 times the time, which is 1.5. From that, you will get the effective annual interest of 14%. So as you can see, the same ang nominal effective interest and nominal annual interest rate, to the effective annual interest rate. So that is the process for the illustration number 3. So all of those computations are the process on getting the effective annual interest rate for the simple interest on a bank loan. Thank you very much for watching. I hope you learned something on today's video. We will then proceed to the next video, which is the topic for the discounted. Thank you. Good day, students.